Hey everyone, welcome back to Corporate Decoder, the place where we figure out if a company is actually living up to its name or just selling us a story. Today we're re-diving into Constellation Brands and their latest 8K filing, which dropped like a sudden announcement on the 15th of October 2025. Before we get into the juicy details, if you like your corporate news straight, no chaser, make sure you hit that subscribe button and join our Discord community, linked down below for even more unfiltered insights. So what is this filing all about? Well, it seems like Constellation Brands decided to raise some serious cash and needed to tell the world about it really fast. This particular report is a Form 8K, which is like a public announcement for major events that shareholders need to know about right away. It is not like a quarterly report where you have months to digest everything. This is more like a breaking news alert. On the 15th of October 2025, the company Constellation Brands Incorporated inked a deal to sell a whopping $500 million worth of new senior notes. Think of it like this: they borrowed $500 million. These notes are set to mature in 2035, meaning they borrowed this money for a good long while. Now, these notes come with an interest rate of 4.950%. That is the cost of borrowing that money, and it is pretty specific. They sold these notes for just a tiny bit less than their face value at 99.716% of the principal amount. This small difference is normal in these kinds of deals. The people buying these notes are a group of big investment banks working together like BofA Securities, BBVA Securities Inc., JP Morgan Securities LLC, and Wells Fargo Securities LLC. They are essentially the middlemen who help sell these notes to investors. The deal is expected to be finalized a couple of days later on the 17th of October. So what are they going to do with all that money? Well, the plan is pretty straightforward. They want to use it for general business stuff, which is a pretty broad term, but they also have a specific goal in mind. They are going to use a good chunk of this new money to pay off another $500 million of their old debt. Specifically, they are retiring their outstanding 4.400% senior notes that were due to mature in 2025. This is a classic move to refinance debt when interest rates are favorable or when you want to change your debt structure. By paying off the older notes with the new ones, they are essentially swapping out one debt for another, likely locking in a longer repayment period, and potentially a better interest rate depending on market conditions at the time of issuance. This whole announcement is tied to a bigger registration statement they filed with the Securities and Exchange Commission, or CCDA. We also filed official documents like a prospectus and a prospectus supplement. These are the official documents that lay out all the details of the offering for investors. What is interesting here is that they refiling a legal opinion from a law firm, McDermott Will and Scholtail LLP, as part of this report. This opinion is basically saying that the notes they reselling are legally valid and sound. That is Exhibit 5.1 for those keeping score. So what can we glean from this? It's a significant financial maneuver. Constellation Brands is actively managing its debt. They are raising a large sum of money and simultaneously retiring existing debt. This shows a proactive approach to managing their financial obligations. The fact that they are doing this through a public offering of senior notes indicates they are comfortable accessing capital markets for their needs. The report is signed by Garth Hankinson, who is the Executive Vice President and Chief Financial Officer. This means the company's top financial officer is putting his name on this announcement. Now let us put on our investor hats and think about what this means. Constellation Brands is a major player in alcoholic beverages, known for brands like Corona, Modelo, and many others. They are not a small startup. This kind of debt issuance is typical for large companies looking to manage their capital structure, fund growth, or refinance existing obligations. Their strategy here appears to be about optimizing their debt. They are choosing to pay off debt that was coming due soon and replacing it with longer term debt. This could be a bet that longer term rates are more attractive, or that they want to keep their financial flexibility over a longer horizon. One thing to consider is that issuing debt increases a company's leverage. This means they have more debt on their books relative to their equity. While debt can be a powerful tool for growth, it also carries risk. If the company's business performance falters, it can become harder to service that debt, leading to financial distress. However, given Constellation Brands' established market position and diversified portfolio of popular brands, they likely have a strong cash flow to support this debt. What is also noteworthy is the specific interest rate they are paying on the new notes, 4.950%. This rate reflects market conditions and the perceived risk of lending to Constellation Brands. A lower rate generally signifies higher confidence from investors. They are also redeeming their 4.400% notes, which suggests they believe the market conditions have shifted, making it more advantageous to borrow at the new rate for a longer term. It is essentially a strategic financial reshuffle to potentially lower their overall interest expense over time or extend their debt maturity profile. Looking at the bigger picture, this move is necessarily a sign of distress, but rather active financial management. Companies constantly evaluate their debt and equity structures to find the most efficient way to finance their operations and growth. Constellation Brands seems to be doing just that, positioning itself for the future. The key question for investors will be how they deploy the remaining capital, if any, after refinancing their existing debt. General corporate purposes can mean anything from investing in new brands acquisitions or just maintaining operations. Overall, this filing paints a picture of a financially prudent company that is adept at managing its capital. They are not afraid to tap into debt markets to optimize their financial health. The key takeaway is that Constellation Brands is proactively shaping its financial future, making strategic moves to manage its debt and ensure it has the resources it needs to continue its business operations and potential expansion. Alright, that is our quick dive into Constellation Brands' latest announcement. What do you think about their debt management strategy? Does it signal confidence or caution? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate secrets decoded. And don't forget to join the conversation on our Discord server linked in the description. Thanks for watching. See you in the next decode.